Hey, good morning, everyone. Welcome to the Sage Capital webinar. My name is Georgia Tubers from Channel Capital, and with me is Sean Fenton, CEO of Sage Capital, as well as Kelly Ma, Portfolio Manager. I'll just skip through to the disclaimer slide.
Have some fun reading the disclaimer.
Yep, you can read that at your own time after the webinar's over as well. And we'll just start with maybe just running through the agenda, which will just be a reporting season wrap, including some insights and themes from both Sage, Sean and Kelly, as well as the current macro environment, just a few points to mention and focus on, as well as the outlook for Aussie equities, and then we'll get into some portfolio positioning and performance. So I'll just hand over, and then we'll just do some questions from the Q&A. So if you have any questions throughout, just put it in on the Zoom chat and we'll try to get to as many as we can. So we'll just start with a reporting season wrap.
That's good.
Sean?
Thanks, Georgia. It's a reporting season, and I think it's probably fair to say the year of 2023 was better than expected. So if we wind back a year ago, inflation was raging a little bit more out of control. Central banks were fighting it, raising rates. There was certainly an expectation that we'd see broader economic weakness, that we'd see households, the consumer, under more pressure, and that would manifest itself a little bit more in terms of corporate margins and profitability. So it's fair to say 2023 turned out better than expected, and that was reflected in the reporting season that we just went through. So more beats and misses. You can see on that chart there that there's been a stabilisation of earnings downgrades. It's always hard looking at these charts. It's fair to say that earnings are always downgraded on average. It's very rare for them to be upgraded. You need a booming economy. That's just because analysts are a little bit more overly optimistic and there's a downward trend. But you can see there that FY24 stopped being downgraded, and even F25 and 26 outlook's been pretty stable. So that's a pretty good outcome from reporting season, shows some of that strength. So the things that really manifested there to us were that cost control was much better than expected. So we saw some broad margin expansion all through COVID for a lot of companies, combination of strong top line, but also pricing power that was going through the market. There's also that was needed in a lot of cases to offset increasing cost basis, cost of doing business. But there's generally an expansion of gross margin. A lot of companies were able to hang on to that despite top line softening, and I guess that was apparent in the discretionary retail sector. I think Kelly will probably talk a little bit about that in more detail later on, but generally the retailers, that combination of stronger top lines and good cost control was rewarded. An area that we were seeing a few headwinds were the select few companies that actually had material interest cost exposure at the short end. So I think one of the features of the last couple of years, and we've spoken about it before, is just the general lack of interest rate sensitivity across the corporate sector, which is really an outcome of previous crises. So the global financial crisis was a massive liquidity crisis. A lot of corporates with short-term debt facilities found themselves in trouble, and ever since, management of boards have been focused on extending debt duration, and they were able to lock that in recent years at very low rates. But there are still a few corporates that have shorter-term floating rate facilities, and they certainly start to come under pressure with higher interest rates. TPG Telecom's one that springs to mind, where there's a higher proportion of gearing and floating rate gearing. So a few of those manifested themselves. We spoke about the earnings revisions, largely energy there. One of the big things that we have seen, obviously, over the last year is normalisation in not so much oil prices, but certainly gas prices. LNG post that Russia-Ukraine invasion and very cold northern hemisphere winters. We've had a couple of warm ones, and LNG pricing's normalised, gas pricing's come down. That's fed through global into lower electricity prices. So that's been weighing on the energy sector a little bit with that LNG exposure at spot. And also, we saw an amazing amount of corporate activity through reporting season. Some for us, some good, some bad. We had a small short in CSR, but managed to close that before the full bid. And we were long Altium and had a little bit of Alumina Corporation there as well. So generally that was going in our favour, but just continues to show interest that says CSR and Ball, they're very much, those takeovers. Seven's already got a lot of Ball, obviously, but a lot of that's around property plays. CSR not so much. I mean, Board's a property play, but the excess property makes that big premium stack up in terms of numbers. And Altium, you've got Japanese there with very low cost of capital, obviously willing to pay high multiples for growth in Renesas bidding for Altium. So a lot of things happening there overall, but maybe diving into a little bit more detail. It's a great little chart there. Do you want to chat on this one, Kelly, or I'll just throw you in the deep end? If not, I'll just keep talking about it.
About the tech being a standout in the in reporting season, and yes, definitely generative AI has been a hot theme as well. So we saw stock performance from a lot of the tech companies that showed a lot of pricing power and the ability to flex their cost base to maintain margin despite cost inflation, plus stocks that had and have good exposure to the generative AI thematic really did well. Stocks like Goodman Group, Megaport, NextDC, those three have pretty good exposure to the ongoing demand for data. So those stocks did really well through reporting season, and generative AI is just going to become a bigger and bigger theme, still in the early days for most companies actually, but in terms of companies that are like harnessing it for their cost reduction, I think that as we roll through the next few years, we're going to see companies that get on top of AI to reduce their costs are going to get ahead of other companies that are lagging and not focus on it so much, because it's going to be a huge productivity boost for a lot of companies.
Certainly a lot of mentions on earnings transcripts and
absolutely
calls of AI, the potential to transform companies. And what's the early stages has very much been that NVIDIA chips, data centers, ability to sell it and rolling out, and that's been a big driver. And we've benefited from Goodman Group and transitioning from industrial property portfolio to data centers and the higher IRRs out of those projects. But as you say, the interesting thing in the next few years is actually how it's going to start transforming companies, their operating capacity, their margins. And there'll certainly be some winners, those that can hang on to those gains and pricing power that could be disruptive for others in more fragmented competitive industries.
Exactly right. And I just think the companies that are focusing on it will end up being the winners down the track. I had caught up with REA yesterday, and they had their board meetings on Monday, and the number one topic that was discussed around the table was generative AI and how we're going to harness this for our product, our coding, and reducing costs. And so it's a very exciting space. And as Sean mentioned before, retailer sales, that was another big thematic, the sales and the costs, really well managed costs. I think a lot of retailers have known for a long time that wage inflation is running hot, and they're going to have to manage those EBA increases in wages in the next couple of years, plus just general cost inflation across the board. And they've been so very disciplined on promotions. So that was another thematic. The gross margins generally held up a lot better than people were expecting, and the consumer didn't fall into a complete heap. So the top lines were actually not too bad either. So and it's been really interesting going into reporting season. A lot of those discretionary retail names had already had a bit of a run, and it was some reporting seasons you see these stocks beat consensus expectations, but then get sold off because they've had a run into the result. This time was a bit more mixed, and I probably have to say that a lot of stocks that had run into reporting season and had a better than feared result continued to run. So that was quite surprising in many cases. So it's and now some of the stocks like the JB Hi-Fi's and the Wesfarmers are trading at historically high PEs, and it's a little bit more where to from here. I think valuations are looking pretty stretched in some of these retail names now.
Thanks. Moving on. So other things, insurers were very strong through reporting season. So that's an area we're quite positive. We continue to be positive on the insurance cycle, with it sounds ironic, but with a large level of global catastrophes, it's really eaten through excess capital in reinsurance pools, and combine that with inflation dynamics going through in terms of getting things repaired and replaced and everything else. That's put a lot of pressure on insurers and reinsurance, which should be bad, but they pass that through. So we've seen big price rises from insurers go through, and some of that's still got to earn through in terms of books and insurance margins. And that cycle's got further to run. Reinsurance is hard, which means the smaller competitors struggle to compete. So we like the big general insurers, IG, Suncorp, where they've got some larger scale and pricing power. But that cycle will also run out eventually as claims inflation moderates. There'll be reserve releases and everything else. Online classifieds, generally pretty strong if we think about car sales and REA. So good cost control there as well. So REA has done a good job of when to invest and when to pull back to manage its margin, driving that premium growth. We're seeing car sales get some good traction in terms of both its global expansions in South Korea as into the SK car, but also into the US with Trader Interactive. So that's been getting some good wins. Seek was probably a little bit disappointing though in reporting season, and with a softening outlook for overall employment, that's probably looking a little bit more vulnerable. Builders all reported pretty strong results. There's a little bit of cycling weather and cost pressures there. So 12 months ago, we were all it was at the end of 2 years of floods. You saw some big cost jumps in terms of coal and energy costs go through, and a lot of that's unwound and really helped margins. And as these things often happen, builders have been pushing through price rises, everything from Boral in aggregate to CSR in plasterboard and James Hardie in siding and everything else. And that's helping maintain margins. So they all generally had good results, although how that sector's been bid for now, so gradually disappearing. In terms of Boral and CSR and Adelaide Brighton will undertake over. What else there? Healthcare services.
Yeah, it's a fairly healthcare services generally they're price takers. Demand is for GP visits. The growth has been fairly muted, so that has flow-on effects to pathology and hospital visits. And given their limited pricing power and compared to the tech companies, their inability to sort of flex their cost base, because a lot of them have very high fixed costs, we saw more muted and disappointing earnings in the likes of Sonic and Ramsay, Ramsay, and then of course Helios disaster.
Certainly, when you combine that sort of had a pretty patchy recovery from COVID in terms of GP visits and pathology referrals, add in there just the structure of private health insurance and affordability, high fixed costs, and throwing a bit of leverage in terms of balance sheet, in terms of Helios and even Ramsay. That creates some pressure. Probably not as bad in terms of the larger healthcare companies, the healthcare growth companies. I'm thinking Cochlear, ResMed, and CSL. Cochlear had a very strong result where it continues to penetrate that adult market,
and still having catch-up surgeries in paediatrics by the looks.
I guess they've got new processors behind the ear implant, which has helped lift margin and stuff as well. ResMed put through a price rise on their latest S11 machine at the end of the year. CSL's always got a little bit of pricing power in IG, so it's not tech-level pricing power, but better than the baseline sort of hospital and GPs.
Exactly.
And resource company margins, well, at the end of the day, it's the commodity price that really drives outcomes for resource companies. But we are seeing broadly higher cost labour availability continues to be an issue. Higher diesel costs, refining margins have driven that up. But really capital costs doing works, they've all been blowing out. A lot of that's a function of labour availability and supply and technical skills as well. So it's continuing to be tight in the resource sector. And if you're like top line commodity prices weak, that's increasing the leverage. But if things are going well, it's not too bad. But fair to say it was a reasonably weak period in the last half for commodity prices outside of iron ore. So they're all sideways to down. Lithium obviously under a lot of pressure. So at the smaller end there, we've seen some real stress. Companies, those in development, seeing capex projects blow out in cost, but also margins being squeezed. Iron ore stocks have sailed through, but since balance date, even the iron ore prices pulled back quite sharply. So high capex budgets, but high cost bases as well. And we've just put all that in a slide and mentioned a few stocks there. So as we were speaking about in terms of growth, tech's obviously been a winner there with that AI thematic. So, and that's I think helped expand margins. PE multiples right across the tech sector. Just that backdrop of Nvidia pushing the Nasdaq. And obviously a bit of a bond rally at the end of last year as well. But generally earnings have been quite solid in the tech space. We spoke about healthcare before, so particularly at that hospital focused end, a bit more pressure on earnings. CSL, the integration of Vifor has been a bit disappointing as well. So some headwinds there. Yield, we touched on some good results from QBE Suncorp. Suncorp also had its sale of its bank cleared in terms of selling that to ANZ, so their appeal to the Competition Tribunal. So that has helped give that a little bit of a boost. But generally we've seen that leverage from repricing insurance premiums flowing through insurance margins. In that yield space, fund managers have been the real drag. A lot of the listed players don't have a lot of FUM growth. So once again, cost pressures pushing through there. And on average sort of performance, those performance fees has seen just ongoing pressure across that segment. Within resources, touched on lithium stocks. That's very much obviously earnings are going to fall a long way when the lithium price spodumene goes from $6,000, $7,000, $8,000 a tonne down to under $1,000, and that was reflected in a lot of earnings results. They're winners in reporting season, which is worth pointing out. We did see a bit of a bounce. It's not really driven by earnings, so we're just talking about price reaction there. And whilst lithium stocks have pulled back a long way, they did have a little bit of a bounce through reporting season, but that really coincided with a bounce in the lithium price. So spodumene has bounced from $800 up to over $1,000, and Pilbara just had a BMX auction, or they accepted a pre-auction bid of SE 6% equivalent at $1,200. So that's helped engender a bit of a short-term short squeeze and recovery in lithium stocks. Similarly, the losers there, coal and iron ore. I mentioned iron ore's rolled across in the first quarter. So once again, it's nothing to do with reporting season. They actually all reported very strong earnings because the iron ore price was very strong last year, but resources companies don't really react to earnings as much as what spot commodities doing. And both of those have rolled over, both in terms of met and thermal coal. Thermal coal's been a lot weaker, as I mentioned earlier, LNG and warmer European winters. So thermal coal's tracked back in line with weaker spot LNG. And iron ore, we've seen pretty anemic start to the year in China in terms of steel production. So annualised steel production in China at the moment is running more at 900 million tonnes, down from over 1 billion. And that you get some seasonal shifts, different timing of Chinese New Year, but we've generally seen all through last year negative sort of margins for Chinese steelmakers and some lower restarts. Stocking levels increasing both in iron ore stocks at the port and China mill inventory. So that's been weighing on the iron ore price. China had their annual planning 2 sessions where they set a 5% GDP growth target, but generally didn't give much tangible big bang stimulus to the market. Sentiment's been quite weak there. So winners and losers really following spot commodities through reporting season there. Domestic cyclicals, the winners Kelly mentioned before, retailers, both top line and the ability to manage margin, less promotional activity has helped them. The losers, Lendlease, continues to struggle. They've been trying to repair their balance sheet for a while, selling things like US military housing income streams, and board selling Barangaroo that sold off their retirement communities business to Stockland. So they're trying to de-gear, but losses in some of their development engineering projects continue to weigh on the business. So earnings continue to get downgraded there. Qantas had a reasonable result, but a lot of political heat flying around. They continue to reinvest back in customer experience, so spending more on the customer, making sure they get their brand image back up, get their on-time performance back on track, and they're doing a little bit of a review of their frequent flyer program at the moment to deliver more value back to members. So good investments for the brand in the long term, but that came at a cost in terms of higher costs into the second half and some small downgrades full year. So Qantas pulled back a little bit on that, but remains extremely cheap. So we remain positive on that, but a little bit more water needs to go under the bridge in terms of repairing brand damage and delivering back to the customer. Global cyclicals, a bit of a mishmash there. US builders, we probably got out of our long James Hardie position a little early there, and missed their big sort of margin recovery and the better performance of the US housing sector. We've since returned in there. One of the best results of reporting season was Seven Group, where we mentioned Bora a little bit earlier in terms of pricing power and delivering through there, but Seven Group as well obviously owns WestTrac, servicing and parts for big yellow Caterpillar trucks wandering around the Pilbara, and that's been very strong and continues to grow as there's more work there, strip ratios going up, that fleet aging. So we've actually gone overweight Seven Group now as they continue to deliver on that earnings front, and really a standout result of reporting season, and importantly generating really good cash flow. So their balance sheet's gone from being overgeared and a bit stretched to looking a lot more solid. Losers Corporate Travel, this is not one that we owned at the time, but a little bit disappointed. Reset medium-term earnings growth targets, and really the underperformance of the UK contract to resettle asylum seekers. They're not getting the volumes through. The market was a bit questioning there as well. There's obviously some political brand risk there in terms of dealing in those areas. So that sort of weighed on sentiment as well as earnings a little bit. REITs, Kelly mentioned Goodman Group before. They've sort of unveiled a massive pipeline of data centre projects, where as opposed to the next DC, they also don't need to put all the capital in to develop them. So they've got some funding partners, but they have the land banks which they can use to transition industrial property into data centres, get some really good IRRs. They've got some very forward progressed plans and a good pipeline. There's a stock, driven a little bit by NVIDIA, has really re-rated through there. And office REITs, continue to struggle as work from home and the new normal just leaves high vacancy rates there, gradually coming towards market valuations, but big upfront concessions on incentives on office to get people in there continues to weigh that sector. Gold, Perseus did well production-wise, Regis high costs and weaker production. Winners and losers and defensives. A2 Milk's done quite well taking share within the China infant milk formula market. Some of the bigger players there have been losing share. A2 has picked up there, so it's had a pretty material re-rate now. Still got some headwinds there as the China birth rate continues to decline. You've got an ageing demographic and falling opportunity set there. And Treasury Ryan, reasonable result, and expectations around tariffs being lifted in terms of China tariffs have helped that rally as well. Helix we touched on before, weak margins and too much debt. Also TPG Telecom a lot of debt and exposure to higher short-term rates, fed through to downgrades there. So that's a quick wrap of reporting season winners and losers. Conscious of time, and I've been waffling on there. I'll give a quick look at the macro side. I won't go into too much detail here, but as with everything in the past year, markets have really been dominated by the outlook for inflation and hence where central banks are going to be moving to. We saw some really material progress in terms of getting inflation under control through the last 12 months. And we expected some of this. So we look at inflation in two parts, and you can see a little bit of that in the slide. The core bit, which is much more services based, driven by labour markets and wages and push through there. And then the more flexible part, which is driven more by tradable goods. And that was heavily disrupted in COVID with supply chain disruption and China closing borders and those sort of things. So the breakout in inflation was both of those: tight labour markets, wages, feedback, and supply chain disruption. We've seen those supply chain normalisers and tradable goods inflation really come right back to zero, the long-term average, but there is persistence there in the core inflation. So good progress on inflation, but the easy gains in terms of volatile, flexible bit has washed out. The harder yards still remain there. So outlook for inflation is moderating, but from here the progress gets harder. So getting from 6 down to 4 wasn't too bad, but getting back to 2 and below will take some more time. So the US Fed obviously pivoted at the end of last year, having made some progress on inflation there. The market probably did a bit of a job in terms of extrapolating that inflation progress in a straight line and analysing shorter term outcomes and saying we're pretty much there, and priced in some very aggressive rate cuts at the end of last year for both the US Fed and the RBA. But since then we've seen inflation just start to bounce back. Core goods is bouncing back around zero and even part of it trending higher. And some of the components of core services in the US here, you can see ex-rents and the like, some of those inflation costs actually trending back up a little bit. So it's going to be harder to actually drive that back down to target. So since then, the market's probably moderated some of those expectations. Bonds yields have moved a little bit higher, and the market's priced out some rate cuts. The other big thing that's been driving markets is just liquidity, and this has been a feature of markets really since COVID, where the central banks worried that we were heading into a deep recession. They went to the GFC playbook, which was a liquidity crisis, and injected oodles of liquidity into the market, and that's been washing around ever since. And this chart just shows reverse repo balances at the Fed. So a lot of this is money market funds holding reverse repos with the Fed. So it's basically money market funds depositing money at the Fed and getting the cash rate. And you can see that level of deposits has really come down dramatically through the second half of last year. And that liquidity is going back into the financial system and helping support activity, but also asset prices. So money market funds going out of reverse repo and back into the system has been quite supportive of asset prices in general. But some of these liquidity dynamics are coming to an end. Consumers are working through excess savings, built up during COVID. Some of those liquidity dynamics are normalising. The Fed's still, progressing with quantitative tightening and letting its balance sheet run off. So we're likely to see that support flip into headwinds through this year, and particularly bearing in mind that the US is still running a pretty big budget deficit, around 8%, that requires a fair bit of treasury issuance. So we saw a bit of a blowout in term premium for bonds, which pressured markets through last year. So the outlook, we could still have some of these episodes in terms of real interest rates and term premium lifting at times and creating some volatility across valuations in the market. So we're quite conscious of that. But in terms of the broader economic outlook, we think it's going to be a slow grind. So the market's wound back interest rate cuts. So the US has gone from expecting probably 10 to now just 3 cuts, but starting the second half of the year. And similarly, the RBA pricing has moved to 1 to 2 cuts in the second half of the year. And that was reaffirmed by the RBA policy meeting yesterday. They've taken rate rises off the table, but want to see things play out. So they'll very much be data driven, as they say, and that comes down to progress on that core inflation. So just a quick reminder. So whilst that's the macro outlook, our real focus is trying to control those risks and exposures in the portfolio. These are the 8 sectors we look at. We've ran through these already in terms of the reporting season, so we've got an idea of what they are. Defensive, supermarkets, telcos, etc. Domestic, global cyclicals, a lot of media, retail. Gold we strip out from resources, growth, high PE, high stocks, REITs, self-explanatory, resources and yield, banks, insurance, managed, etc. So they're those 8 sectors, and this is how the portfolio broadly looks at the moment, positioning-wise. So, the important thing to take here is the dark blue bars on the right, the light blue aqua bars on the left, gross long and gross short exposures. What we're really looking here for is a range of long and short stock positions within each of those groups where we can make money active returns over the relative performance of those stocks, but control the net exposure, so those dark bars. So we're not taking big macro thematic tilts. By the same token, we don't want to be sailing into the wind, so to speak. So we want to have that aligned with our positions. So actually, if you just go back one slide, George. So you can see the yield. We've got a little bit of the underweight in banks at the moment, which look very stretched, low earnings growth from that perspective. That's balanced with overweights in cyclicals and growth. So there's overall pretty neutral exposure across the portfolio. So just jumping forward there. So just a quick review of the last 12 months in terms of performance. So been pretty flat active performance and been pretty choppy over the last year. So it's been a bit of a tougher environment for active management, and sometimes the market goes through these phases. So you see periods of for active management performance in particular will surge for a few years and then plateau and consolidate for a while and then surge again. And that really reflects what's happening in the underlying market and the economy. So we're really looking for identifying shifts in earnings and trends and material mispricings in the market. So when you get a lot of disruption like we had through COVID and border closures and stimulus and fiscal monetary stimulus, liquidity, recovery, but then inflation breakouts, fighting that with interest rates, that creates a lot of movement in terms of earnings, a lot of valuation shifts, and a lot of opportunity for active management. What we've been through in the last year is more churning markets, where the market's been vacillating, flip-flopping between inflation's good, it's bad, the Fed's going to tighten, it's going to cut. So we've had sort of range-bound choppy markets. And those thematics have really dominated a lot more than company specific. So companies have traded more as thematic proxies and the market's ignored a little bit what's happening there. So they can be tougher markets. But in those periods, sometimes you do get valuation discrepancies and changes which the market's ignoring, and that sets the groundwork for future performance. So over the last year, things that have worked well, resources, we've traded probably lithium around particularly well there in terms of being a bit long and short than long again. Looking at the overall dynamics of lithium, just prices got way too high at the start of last year. Demand pulled forward with China's subsidies ending. We saw that normalise and prices come off. Then you had a bit of a delay in penetration of EVs in terms of take-up with affordability, and you had a little bit more supply coming out of Africa, and you saw what you had. The market went into surplus and prices collapsed. So a general strategy was to be long Pilbara through that period, which was obviously net cash, low on the cost curve, able to continue expanding production at Pilgangoora, and was definitely the best performing lithium stock through that period. On the short side, we've got Sayona there, but a range of other things like Core and Lake and some smaller things that really came under pressure, those that are in development and unable to deliver. Other things there within resources, short sims have been long blue scope and short sims. It's really reflecting some of the dynamics around the steel markets that have been coming through. So China, we mentioned earlier on that Chinese steelmakers have been loss-making for the last 12 months. As a consequence, they've been producing more steel than there's been demand for. The steelmaker margins have been negative. They've been exporting increasing amounts, and that's been suppressing steel prices globally as well. At the same time, you've actually seen really strong demand in the US. So think about the Inflation Reduction Act and the way that stimulated infrastructure spending. Also, trade wars, the theme of companies moving to more local supplies, so onshoring, more factories being built in Mexico and continental US and other places. And this has all helped drive domestic steel demand in the US. And tariffs against Chinese steels meant that it hasn't been able to come in. So you've had much higher steel prices in the US, which has benefited BlueScope, their North Star mini mill there, which has been getting great margins, earning great cash flow. On the flip side, it's hurt Sims, where they basically collect scrap in the US, which there's been a lot of demand for, and it's hard to get supplies, been more expensive. And they ship it out, sell it to Turkey, where it's converted to steel and sold into the Middle East and Asia. So those margins on collecting scrap and selling it into Asia between strong the US and China exporting excess steel and softening margins, Sims margins really collapsed there. So being long BlueScope, short Sims also worked really well. We mentioned REITs, Long Goodman Group, as a stock that has very low gearing, manages its earnings extremely well through the cycle, has a good funds management business, but has taken another level up lately, as we mentioned, converting some of those industrial land banks into a data centre pipeline. Within growth, along Telix, it's managed to grow earnings. It's rolled out its prostate cancer diagnostic, Allucits. It's got a good pipeline of other treatments and diagnostics coming as well. And WiseTech had a very good result in reporting season, but continues to dominate that global sea freight, moving increasing to land freight in terms of custom software and management there. Domestic cyclicals, we touched on Qantas before. Long, that's been a bit of a headwind. Generally, global cyclicals have been a little bit of a headwind. We've sold out of our US housing exposure too early there. There's a few others of travel and ag-related names have been volatile. And defensives, we've had some good stock selection there, but just hasn't paid off. The market's sort of over-rewarded a few things and punished others. Probably the biggest drag there's been AGL, where it was a good stock for us through the first half of the year, but traded down very much with forward electricity prices as coal and gas prices came off. People worried about the earnings, not really giving the benefit of the doubt to the company in terms of their ability to flex Loy Yang, the coal-fired power station, and take advantage of intraday volatility, more solar rooftop, but taking advantage of that through batteries and investments there. Quickly on positioning, we've touched on a lot of this already, but defensives, I just mentioned AGL, but we like Telstra as well. Good industry structure, Optus and Vodafone both struggling with cyber defence, ability to leverage balance sheets. So we're seeing mobile pricing being quite strong. Telstra has tripped over a few things, such as business wholesale, but generally very safe earnings, reasonable growth. We like travel, convenience retail still. The sort of two-engine consumers still very much there in terms of those with assets and those with mortgages, so skewing towards older demographics with travel still works well, whereas media and some of the consumer discretionary starting to cycle down with those pressures on the consumer continuing to mount as that sort of fixed to variable mortgage rate impact rolls through. Global cyclicals, I mentioned Seven Group before, very strong result with WestTrac. Orica we quite like in that space as well, which is delivering high margins on ammonium nitrate and blasting. Gold, we're just generally looking for higher quality producing mines. Newmont's looking interesting now after a bit of a pullback and some short-term disruptions, but generally funded with higher cost, low mine life older mines. Growth, there's a few stocks there that we're long: ResMed, WiseTech, Car. We were long Altium, but it got taken over. ResMed's still bouncing back from GLP-1 disruption. Major competitors out of the market. WiseTech moving towards a monopoly position on cross-border freight software. Car I mentioned earlier on as well. A lot of these stocks in this space have stretched valuations, but we're really looking to fund those positions with some of those with more earnings downgrade risk, more exposure to domestic economy. Things like SEEK probably look a little bit more vulnerable there and had a weaker result, and their growth probably a little bit more challenged short term. REITs, Goodman Group, we mentioned, funded by Office Resources. Short term, we've taken a long position in lithium, but that's a very short term trading position. We'd struggle to see the lithium price moving too much higher than what it's rebounded to now in the short term, just as EV penetration slows. There's risks around tariffs on autos in Europe and US. But we do like copper long term, so that no real new mine development that moves into deficit in the next few years. That's starting to move already. And mentioned earlier, iron ore and coal, China looking a little bit softer there, and that's still cycling down. And insurance versus banks. So insurance I spoke about earlier on, there's still got premium rate rises going through, earning through to higher insurance margins. Banks have rallied very strongly since the end of last year, since the Fed pivoted, bond yields came down, but there's not really a lot of justification for that. So we don't see a lot of top-line growth. Credit growth is pretty anemic as the household's very leveraged. So it's hard to get enough rate cuts to really grow that through. I think George is giving me the hurry up on the slides, but
just in the interest of time, maybe we'll just we've only got a few minutes left, so we can just
maybe stop there and skip questions. Yeah. So.
Just 1 second, I'll just check the screen. Maybe in terms of the volatile year that we had last year, what do you think will be triggering more volatility this year besides US elections, Trump versus Biden?
I think some of those liquidity dynamics I was speaking about earlier on, I think the biggest risk is probably a little bit of complacency around the US fiscal position. So generally, the US budget deficit moves around with the unemployment rate as natural stabilisers. There's really stark contrast at the moment. You've got like record low unemployment and very high budget deficit. So the problem there is if the US economy weakens at all, then that budget deficit, so there's that structural deficit that's been in place. So that could continue to blow out. Even without that, they need to keep funding that. So on monetary theory says that's all good and well, but bond markets start to worry and demand a higher term premium. That can still be destabilising for markets. The Fed's still running off its balance sheet, so QT. There's a lot of debate around the minimum liquidity of the financial system these days, so that could create some dynamics and some volatility. So there's those mechanics, bond market volatility disruption that could impact the overall market.
There's also the most elections
Elections
globally
towards the end of the year, but
like 60 years or something. It's it could.
So geopolitically, there's going to be a lot of noise coming through in terms of Trump v Biden and policy agendas there. So the election's at the end of the year, but that'll definitely be the tone. You've got shift to the right wing at times. And then you've got geopolitics. You've obviously got Russia-Ukraine war still going. I don't think anything imminent's happening between China and Taiwan, but tensions there continue to mount. You've obviously got now Israel and Gaza that's flowing through the Red Sea. We've seen a lot of disruption there, higher shipping rates there. So there's some inflation risks there. The oil prices started moving back up. Liquidity, geopolitics, they're probably the three that we're really focused on.
And there's one question that's come through, given the increase in copper and iron ore prices, do you see any decline in investment shorting opportunities?
There's always shorting opportunities. So the question is whether they're long opportunities and what you should short on the other side. So we're definitely long copper at the moment. The problem is there's not a lot of pure copper exposure in the Australian market. So we own Sandfire. There's a couple of Canadian American companies coming to our market, maybe bringing some liquidity here in the copper space. There's some secondary players, BHP and Rio with Escondida. Some of the gold stocks have copper exposure. But we're along there, so then it's a question of what you fund it with. So there's opportunities in coal or energy or lithium to fund that. So there's always relative winners and losers. Even if the whole sector is going to the moon, you just you can make money being long whatever goes up the most and short what goes up the least. So a strong broad rally across a whole group is not a lost opportunity. There's still relative winners and losers there.
Yeah, great. There was a few stock-specific questions, but we've covered a lot of that in the webinar. Any more insights on generative AI? I know we covered that a lot and mentioned a few of the sectors that would benefit from it. But
well, I think it's just, as I said before, I think it's and most companies will acknowledge that it's very early days, and there's a lot of testing and beta going on in the background, and lifting up of a lot of the R&D budgets being allocated to generative AI for new product development, but also on just reducing costs. And like Light and Wonder's an example where they've talked about how they're now using Gen AI to help them code their new products. So that's helping them reduce their costs, and also helps them with new product generation. So, but it's going to be a while, particularly in Australia. So we actually, other than the ones we mentioned before, Goodman and Megaport and XDC, probably going to be a slow burn in terms of actually seeing who the Aussie company winners are in Gen AI.
Yeah. There's obviously, it's very applicable to language and complex language. So it's used a lot already in call centres and chatbots and those sort of things.
Yeah, that's AI versus the generative AI.
Generative AI. And then you get into like QB, when I was talking to, like, where you've got complex contracts, insurance policies, and a lot of different exceptions and the like, and it takes a lot of time to process and price. The ability of that unstructured complex data, that's an area where AI can get in and
make jobs more interesting and people more creative, and hopefully innovation will accelerate because of it.
Definitely. Well, that's all we have time for. Sorry for going a bit over time. Thank you, Sean and Kelly, and thanks everyone for dialing in to the webinar. As always, we'll send an email with a presentation pack, but if you have any questions or would like any more information, please contact your Channel Capital contact. It's just on the screen now. Otherwise, thanks for joining and have a great day.
Thanks all. Cheers.
Thanks.